This is Professor Hazer again, and this is the third video of contemporary hedging. And remember that there's two types of hedges. One is a cash flow hedge, and the other one is a fair market value hedge. Okay, so we just had an example, rather lengthy example of a cash flow hedge. This one over here, and I'll send you the worksheet, and you've got the video. To the right of it, we're going to do a version. It's a very close problem, but I started this one on December 1st, 2015, rather than November 1st for certain reasons. Okay, but it's basically the same problem, and you've got the same rates here. So I didn't work them into the Excel worksheet. This is a much shorter example. Fair value hedges are much shorter. And one basic rule for a fair value hedge, and I mentioned this in the first video, the PowerPoints, but I'll mention it again, for fair value hedges, all exchange gains and losses go to net income. And I'm correct in saying that these types of hedges, now in this example, I'm just going to take the same, to make it easier, I'm taking an account receivable and saying, basically using a fair value hedge on that. And it's possible. Actually, it's possible to do that. Not likely, but possible. And but fair value hedges are usually used for instruments such as held available for sale and trading securities that you buy internationally that you would want to hedge that are marked to market, and you want to hedge those mark to market changes. So you're hedging the changes in market value, things that usually change in fair market value. That's usually mark to market. But in this case, we'll just use an account receivable example. Those other things like swaps and stuff can get pretty complicated. So we'll just stick with this. The main thing is that when you use a fair value hedge, you've got to mark the derivative itself to market. And so let's just start. And it's very close. Actually, the mechanics of the accounting are very close to the basic hedges that we had back here, hedge net asset or hedge liability. They're somewhat close to that, although the discount or premium we treated slightly differently. Okay, so we have a transaction here. December 1st, 2015, U.S. company sells and delivers 10,000 teapots to a British firm for 100,000 British pounds. Call it whatever transaction you want. Pounds will be received on January 30th, 2016. So this is a 2-month contract, not a 3-month. Order that has transactions. On December 1st, the company enters into a 60-day forward contract to sell the pounds to the exchange broker. There's the following rates. Okay, so we're going to actually record the forward contract here, but it's going to be at least explicitly without a discounted premium, but that's going to be accounted for in how we value the forward contract. And then transaction 2 is you close its books December 31st, and then you're going to do the usual updating of the books, exchange gains and losses on both the account receivable, and we're going to mark the forward contract to market. And then finally, we're going to close everything out on January 30th, 31st, whatever date that is. Okay, so first of all, we're going to debit accounts receivable foreign currency. That's going to be for 100,000 pounds. I will change what I've been doing all along, but I think it's a good idea. And notice that the spot rate at this date is $1.70. So, no, what I'm saying is the spot rate that date is what I'm saying it's $1.50. So I will mark the spot rate. So I'm using this spot rate right here. Using this spot rate right here. And that's $1.50. And go ahead and credit. same amount. Okay, so it's going to be valued at 100,000 times 50. That's going to be, I got to change that to dollars so that it puts it in dollars. I need block will actually put it in dollars. So do this. Okay, and it should be dollars. Change this to I thought that the program might be somewhat patriotic. Okay, so I'll change this to dollars here. Okay, and so you're going to record $150,000 in sales revenue. With that, okay, the transaction 2 is to record the forward contract, and it's going to be somewhat similar. In fair value hedges, you record the forward contract, and then we're going to have a gain on the accounts receivable, and we're going to mark the forward contract to market. Which is not what we did before. We just sort of use it as a perfect hedge against the accounts receivable. Now we're going to just mark it to market, and it should generally go in the opposite direction. With exchange rates moving as expected, it should go in the opposite direction. It won't cancel the whole thing because we're going to discount it, but it should go in the opposite direction of the receivable. You have to get a little bit into the theory of derivatives there. So we're going to record the forward contract, and then okay, so we're going to have contract receivable, and this is going to be fixed. It should be fixed at the 60-day forward rate, like it was before. So you're going to deliver these. You're going to get 100,000. You're going to get 100,000 British pounds from the exchange broker. You're going to deliver those on January 3rd, and you're going to get a fixed rate of $1.45 on each one. So you're losing. It looks like it's a discount. Yep, and you're gonna be losing 5 cents per each one. But you're willing to pay that 5 cents in order to have peace of mind. Let's say so that's contract receivable fixed, and we're gonna have a contract payable. This one is gonna be denominated in foreign currency. So I'm gonna put an FC side there. Okay, so this, and this is going to be valued at 1.45, which is the 1.45, which, if you notice, is the 60-day forward rate on a contract. Okay, so and that makes sense because the contract is fixed, and that's how much you're going to pay. Excuse me, that's how much you're going to receive in this case for the 100,000 British pounds that you deliver. Okay, one thing about this is that you may be asking yourself, where's the discount or premium? In this case, where's the discount? Keep in mind it's discount because the forward rate is less than the spot rate. 145 is less than $1.50. 145 $1.50. You've got in there a discount of $5,000. And in a sense, what you'll see at the end is that sort of like we've been doing all along, ultimately, if your hedge is 100% effective, the only thing you're going to end up expensing here, because it's going to be like an expense here, because you're not getting as much for these. You're getting a nickel less for each one than the current spot rate, so it does come down to expense, is that the ultimate expense in all this is going to be the hedge cleans itself out, cancels itself out, and only the discount in this case will be an expense at the end. Okay, then we come to, let me put a line here like I've been doing. Line here. So we get to the next date. Next date is 12/31/15. Well, as we'll put the next line down here. That's the settlement date. Okay, so this one here is to record a gain on accounts receivable. Why is it a gain? Because the spot rate goes from $1.50 to $1.60. So that account receivable is worth 10 cents more on each one. Okay, so the basic rate where we're going to debit accounts receivable fixed foreign currency, and we're going to debit exchange gain, which goes to the income statement. It goes right to the income statement, and the number of units foreign currency amount. The exchange rate we're going to use now, though, is $1.60 because that's the spot rate at 12/31/15. There it is right there. There it is. I'm putting my cursor over it and circling. Okay, so hovering over it. And change that to $1.60. Okay, then we got 100,000 times $1.60. That amount right there. Just a minute. Yes. And that right there, we're going to change all these, make sure all these marked as dollars, because remember, you're reporting currency, you're an American company, and your reporting currency is the US dollar. Even if you're holding pounds, you have to show the dollar value of those pounds. Okay, now the next one is, and obviously the next one is going to show kind of the hedge, but we're going to mark the next one. This is really what we did last time. I didn't use the words. I implied it, but I didn't use it. We're going to mark the forward contract to market because all financial instruments have to be marked to market. And a forward contract is a financial derivative, and it has to be marked to market. When what you're showing really is you're going to be showing the change in the market value from the time that you got it. Okay, we'll do the basic calculation. Okay, and let's see, I may have it down here. No. Here's what I'm going to do is this entry, I'll put the accounts up, and then I'm going to bring the calculation in from the other sheet, which might not be a bad idea. We're going to have, we had an exchange rate, exchange gain on the account receivable, so we have an exchange loss on the contract payable. That's also denominated in foreign currency. Okay, and the amount is going to be, we're going to mark it to market. And the calculation should be something like this number here. Assume 12% again. Should be something like that number right there. And I'm sort of doing this on purpose to draw your attention to this. So we'll put this calculation out here. Back paste. Okay, and the amount that we're going to put in is equal to negative. Okay, negative. The loss on the forward contract. That amount and that amount. I'll explain this in a second. Let's put this in dollars. Okay, but let's go ahead and do this calculation. Keep in mind that just like the past problem, let's go ahead and stretch this out a little bit, change the labels a little bit, because I changed the dates a little bit. The currency, the total base currency is 100 pounds here. That's your base. Okay, the 60-day forward rate on this should be labeled in this case 60-day forward rate on 12/1/15 was $1.45. There it is. So when you initiated the contract, the forward contract in essence had a value of $1.45 because that's what they were predicting that the currency would be worth. However, 30 days have gone by and 30 days are left. So the 30-day forward rate, now that's correctly, on December 31st is $1.55, so that has not changed. Okay, so the loss is going to, you're going to have this. It's 100,000 times the difference between $1.45 and $1.55, which is a $10,000 loss. Let's put that in dollars now. these in dollars too. Okay, and we're going to discount it back. Now we're discounting it back. R is equal to 12%, like in the last 0.12. Okay, and you've got a month to go. You're discounting it back basically from uh, January 30th or 31st, 2016, back to December 31st, 2015. And so the discounted value of that loss is $10,000, so, or $9,900. So that's the loss. And it's not exact, but a lot of these principles don't come necessarily from the standards on exchange transactions. They come from the standards on the new standards that came out all in the last couple of decades on marking securities to fair market value, and contract payable is marked to fair market value. Now notice that basically you do have a $10,000 loss here. You have a $10,000 loss right here. I got to change this. I don't know what I did there, but it's discounted back. Wait, I have to change. This should be $1.50 here. 1.50. $1.50 right there, or equal to that. Doing there. This is equal to 100,000 times equal to 100,000 times the difference between $1.60 times $1.50. $10,000. So anyway, so accounts receivable went up because each one is worth now $1.60 rather than $1.50. So you've got $160,000 in there. I was telegraphing myself 150 plus 10, but it started at 150 and now it's gone up by 10 cents each one. And in a sense, the forward contract is being valued on what forward contracts, as their name implies, are looking forward. So initially, the 60-day forward rate, because you were 6 days from settlement, was $1.45. Now you're 30 days from settlement, so you're looking forward, and it's $1.55. So from a payable perspective, that's a loss. If through a receivable, actually, it'd be a gain, but from a payable perspective, it looks like you're going to have a loss because you're going to give up something with a greater value on that contract payable, but it's discounted back in order to show its current value. And that goes, by the way, it's very close to how you price financial derivatives. Okay, but anyway, so you do have an exchange gain or loss there, and it'll clean itself up at the end. Okay, so in these final transactions on January 3rd, we're going to collect the pounds from the British customer, sell the pounds to the exchange broker for the fixed fee, or we're going to sell the pounds to the exchange broker for 145 basically, and record a loss on the transfer of the pounds, and then finally collect our $145,000. Okay, so the first thing you do is you have to collect the pounds. This is the easiest one. This is one of those fairly easy ones. We're going to collect cash, and this is foreign currency. It's not denominated foreign currency. Like I keep saying, it is a foreign currency. So you're going to collect the pounds, okay, and so you're going to debit cash. You're going to wipe off for accounts receivable for currency here. It has, by the way, $160,000 in it. And then it looks to me like, let's go back and look at the exchange rates here. It looks to me like you're going to have a gain on this transaction because the spot rate is $1.70 right there. Okay, so this is our credit column here. So let's go ahead and collect the cash. Collect cash. Got the base is 100,000. Okay, that cash today is worth 1.70 each, so $1.70, and we will change this, make this into right there. So the cash, the pounds that we get are equal to 100,000 times the spot rate on 1/3 on the at the end of January of $1.70 right there. Okay, the accounts receivable give up. The easiest way to do this is just to add up the balance of the receivables. The receivable account, which is 150 plus this 10 right here, 160. So we are going to have an exchange gain of 10 there. That looks good. The other way to do this is you could have just taken 100,000 and taken it times the last value that it was adjusted up to, in this case, $1.60. That's the other way to do it. And we're going to have 1, 2, 3, 4, 5 exchange gain on this transaction, which is equal to the difference between the two, which is 170 minus 160, obviously, or 10,000. The other way would be you could just let you use your imagination. Take 100,000 100,000 units of foreign currency times the difference between 1.70 minus 1.60. That's the other way you could calculate that. Okay, now we come down here, and this transaction is going to be, we have to sell the pounds. Exchange broker, we're going to, these last two transactions kind of go together. So we've got $100,000 worth of pounds. We're going to sell those to the exchange broker, and so we're going to have a credit to cash, 1, 2, 3, 4, 5, cash, which is foreign currency, and we're going to debit the contract payable, and in this case, it's going to be for whatever we have. It should be for whatever we have in the contract payable count, or excuse me, it should be, yep. Just making sure here. So we're going to have contract payable and currency. Okay, and we're going to have an exchange loss in this case. Okay, the cash that we give up, I don't even have to tell you, it's the opposite. It kind of looks like the initial examples we had, except we don't explicitly record the discount. We will implicitly, as you'll see at the end, and we discount the contract, okay, which is, so we might as well go ahead and just say this is 100,000, and we're associating that with $1.70, which calculated in the exact same way. I'm just making the number equal right there. It's calculated the same way. Okay, the contract payable account has a balance of that plus 99099. So there's your contract payable account. That's just your balance. Put balance in here. And the difference between the two will be your exchange loss, which is 15499, that minus that number right there, which gives us, or the other way around, doesn't matter. Negative. Pretty positive number is a loss. But the debit means a loss. Let's 15099. And the 15099, I'm using the same numbers as I use. I'm going to block this here. I'm using the same numbers as that we used last time. I'm using it. The total loss on the contract is $1.70, which is today's spot rate, less what the original predicted value was, 145, so that your total loss is 25,000. Take 25,000, take what you've already recorded a loss. You've already recorded a loss of that amount, which gives you that number right there, 15099.01. So your total loss on the contract payable is 25,000, which is basically, and it kind of makes sense because it's basically what you predicted initially with the market rate of $1.45, and what it actually turned out to be $1.70. So that's the amount over by which, that's the excess contract payable that you ended up paying. And the final thing you do is look at the cash flow. You collect the pounds, sell them to the exchange broker. Now the exchange broker owes you some dollars. So you're going to put cash. This is the easiest. Well, and I will put dollars here. I shouldn't have to, but cash, and this is going to be contract receivable, which was fixed. And these are going to be equal to the original fixed $145,000. That number right there, that number right there. Everything up here has cleaned itself out. It's not as complicated as the cash flow hedge. Everything has cleaned itself out. So the accounts receivable was 160. Accounts receivable is gone. The sales revenue gets closed like all revenue does. Contract receivable fixed, debit for 145 and credit for 145. So that's gone. The contract payable, or so you have a debit for 140, a credit for 145, credit for about 99. That's about brings it up to 150, just short of 155. But you have it's cleaned out net credit right there, and the exchange loss is equal to, on the contract payable, the total exchange loss is equal to the difference between the 100,000 value at the spot rate, which was came in at, and the original forward rate, which was the predicted rate. So the market really blew that valuation. Obviously, this is an exaggerated example, but you have to exaggerate sometimes. And you may be asking, what happened to the expensing of the premium? What was the premium expense? Well, the premium expense is, let's go ahead and add up. I'm going to take exchange gain on accounts receivable and exchange loss on contract payable. Okay, the exchange gain on contract receivable, accounts receivable is going to be, start here, we have one exchange gain there, plus should have had another exchange gain right there. So the total exchange gain on the accounts receivable is 20,000. Now, on the contract payable, the total exchange loss is that 9,900 plus at 15,099. By the way, that $99.01 is the thing that's due to this, the discount. It gives you 25,000. So on a net basis, the thing that did count, like I've been telling you, is the discount, which was $5,000. So that minus that gives you the discount of 5,000. That's what you ended up losing. A discount, and I'll say paid here. Yeah, in a sense, you paid it. You did pay it in a sense, but that was a discount. So in a sense, you mean, well, where's your discount? The discount is, I'll put a line here. So discount is the difference between what we made on the account receivable and the exchange loss on the account payable. So, and that was the original, the contract payable, and that was the original discount right here, 5,000, which is 100,000, which is the difference between this 150 at 145. So anyway, so the discount did count, and that's the thing that ended up being expensed on a net basis. Okay, so I'm going to go ahead and you can see me do this right here. Save this. Okay, I'll be putting this up in terms of homework problems. I'll just give you a couple of basic homework problems. I do feel that I had to talk about these two topics because it is something there's testing a little more on the CPA exam. The problem is you just don't know what derivatives they're going to use, how they're going to hedge, and everything. So the best thing to do is know the basic concepts. And I may put up a very easy video with definitions if you want to review it. But know the basic concepts, and then work from there, because they could have you hedged using an option, which wouldn't be 100% effective. It wouldn't effective means it cancels out the entire losses and gains on the receivable or on whatever you're hedging. They could have used a swap. There's all sorts of things they can use. So you should at least start learning these terms. And there's accounts that specialize in this. They spend their lives on this stuff. So, and they're usually accounts with a very good finance background, by the way. So I'll save this and we'll stop this video and I'll put this up.